Today I'll be going over Section 4, Topics 1 through 8. So Topic 1 begins with how a person's investment risk tolerance depends on factors such as personality, financial resources, investment experiences, and life circumstances. So several examples that may influence a person's risk tolerance include age. So the younger the investor, the higher the risk tolerance may be because of a longer investment horizon. Financial stability. People with stable incomes and emergency savings typically can afford to take more risks. Experience. Experienced investors may feel more comfortable with higher risk assets like stocks. And goals. Long-term goals may allow for more aggressive investments, while short-term goals favor safer options. A person's risk tolerance often influences their investment decisions. For example, if you have a higher risk tolerance, you could potentially earn higher returns. Examples of this are stocks and riskier assets that may provide greater diversification and inflation protection over time. However, lower risk tolerance investments could cause people to stick to lower or no risk instruments like bonds, certificates of deposit like CDs, and savings accounts. And these will typically earn lower returns over time. For example, historical averages show like small company stocks or larger company stocks earn higher returns than corporate or treasury bonds. And examples of risk are typically increased volatility, emotional stress, and potential for significant short-term losses. Understanding risk tolerance helps us create a balanced portfolio aligned to personal comfort and financial goals. People can also assess their personal risk tolerance using an online tool or worksheet. Online tools and risk tolerance questionnaires can help individuals assess their comfort levels with different investment risks. These tools often consider things like income, expenses, age, investment knowledge, and financial goals to recommend suitable strategies. Some examples of such worksheets or tools include Vanguard's Investor Quiz, the University of Missouri's Investment Risk Tolerance Assessment, etc. Next, for Topic 2, investors can earn investment returns from price changes in annual cash flows, such as interest, dividends, or rent. And the nominal annual rate of return is the annual total dollar benefit as a percentage of the beginning price. So here are a couple different types of annual cash flows that can be received by investors. So first, interest is a fixed payment received by investors who hold bonds or other fixed income assets, and these represent a return on their investment in the debt. For dividends, these are periodic payments distributed to shareholders by a company, and these represent a portion of the company's profits. Rent is just regular payments received by an owner of the property from a tenant who leases this property, and is considered a form of income from an investment in real estate. Next, I'll be comparing nominal annual rates of return over time on different types of investments, including cash flows and price changes. So first, stocks have higher nominal return possibilities from price appreciation and dividends. However, they are also usually more volatile. Bonds, on the other hand, pay a stable return, a fixed return in the form of interest, but usually have a lot lower growth potential. Real estate can provide flows of income through rent and appreciation in value, though there is property management risk also involved in this process. Cash equivalents, such as savings accounts or CDs, offer the lowest nominal returns but are the safest investments. Assets that don't generate income or are subjected to extreme price volatility are often considered speculative investments due to the following reasons. So first, lack of regular income. Speculative assets do not have ongoing cash flows, unlike the dividends from stocks or interest received from bonds. Investors only depend on the price of appreciation for profit, which is solely dependent on finding someone to pay more for the asset in the future. Next, high price volatility. Most of these assets are prone to high and unpredictable volatility of their prices, normally because of market sentiments, shift in demand, or even external events. For instance, cryptocurrencies can surge or lose a lot of value within hours because of news or speculative trading. Next, uncertain intrinsic value. The value of speculative assets is hard to measure because many of them lack any intrinsic or inherent worth based on cash flow or utility. For example, while a stock can be valued by points or future earnings, the value of a collectible is subjective and relative, depending on perception and scarcity, and how much other people are willing to pay for it. Dependence on market sentiment. Speculative investments are often highly susceptible to investor behavior, trends, and market hype. Prices are more often emotional decisions than fundamental economic drivers. Risk of total loss. Because the speculative assets are not linked to productive output, there is a greater risk of complete loss if market demand evaporates. For example, some cryptocurrencies will become dead, and collectibles could lose their value in case of changes in trends. In conclusion, speculative investments are considered high risk because they do not provide reliable income, are highly volatile, and depend on uncertain price appreciation in the future. While they do offer the possibility of high returns, they are also best suited for investors with a high risk tolerance and a willingness to accept potential losses. Topic 3 will be covering rates of return and how investors expect to earn higher rates of return when they invest in riskier assets. So some advantages of investing in assets include higher returns. The riskier the investment, such as growth stocks or small company shares, the much bigger the potential gains may be compared to less volatile investments like bonds. There's also a lot better diversification for a better portfolio. A mix of riskier assets increases the balance of your investments for better earnings over the long term. This also would beat inflation. Hopefully, in the long term, riskier assets like stocks generally outpace inflation, thus growing your money. And there's also more chance for bigger growth, so much riskier investments have the potential for larger growth, greatly increasing in value and are pretty great for the long-term building of wealth. However, some of the disadvantages include more volatility, investing through turbulent undulations, so in the short term, you can lose money due to a drop in 1 year and a high increase in another year, and this potentially leads to more losses. There's also a lot more uncertainty, so riskier investments results in the riskier the investment is, the results are less predictable, which causes a lot of tension. There's also risk of total loss. This is always a risk in losing everything put into a high-risk investment, such as a struggling small company. These also require attention, so higher-risk investments normally involve more attention and thus greater effort, which may take more substantial time. So here are some long-run average return rates of several assets. For a small company stock returns, your average return would be around 11 to 12% per year. And the reason for this would be that smaller company stocks are intrinsically riskier because companies that issue such stocks are usually less established and thus more vulnerable to changes in the market. And for that additional risk, the long-term average returns would be correspondingly higher. For larger company stocks, the average return would be around 8 to 10% per year. And the reason for this would be that the stocks issued by larger companies are more stable and because the companies are more established. And these are less risky compared to smaller company stocks and have correspondingly lower returns on average. Corporate bonds have an even lower average return of about 5 to 6% per year. And the explanation is that corporate bonds are loans given to companies with returns in the form of fixed interest. These are less volatile than stocks, but more than government bonds, and the returns are relatively moderate. Treasury bonds have an average return about 2 to 4% per year, and these are considered to be one of the safest investments because they are backed by the U.S. government. The lower the risk, however, the lower the return compared to stocks and corporate bonds. The expected rate of return on a value stock or mutual fund is typically likely to be lower than that of a growth stock or mutual fund. This is because of lower risk. Value stocks represent stable, well-established companies. There is much reduced risk associated with an investment in them. Investors are bound to consider lower returns only because they expect steady cash flow from these companies, predictable earnings, and a reduced possibility of high losses. For a second point, they also have limited growth perspective. On the other hand, value stocks have lower prices compared to their main indicators, for example, earnings and book value. Growth is always a bit sluggish, however, it is always less costly. Due to this, their stock prices never go sky high like growth stock shares. Furthermore, for dividends, value stocks typically pay dividends and are, therefore, a reliable source of periodic income to investors. The presence of dividends also reflects lower possibilities for appreciation overall in the stock's price. Thus, the return is lower as compared to growth stocks, as the latter typically reinvests their earnings in further expansion. So growth stocks are those of companies that, generally speaking, one can expect to grow earnings or revenues at better than average rates. Normally, they are considered to be riskier investments, and their success depends on whether high growth expectations are attained. This increased risk tempts investors with much higher returns. So bonded longer maturities generally earn a higher return than short-term bonds, and some of the factors that play into this are the interest rate risk. With longer terms of bonds, their sensitivity to any interest rate change increases. Their prices fall sharply with rising rates, making them much more volatile, and investors in this respect need to be compensated with higher compensation to bear the additional risk. There's also liquidity risk. The problem here is that long-term bonds cannot be sold as easily and quickly without discounting the sale price. This, of course, is less liquidity or reduced flexibility, which would encourage the issuer to give higher returns to investors. There would also be uncertainty over time. The longer the maturity of a bond, the greater the uncertainty factor concerning future states of economies, markets, and even credit risks. The higher returns play the role of a premium for the uncertainty taken. Next, I'll be talking about topic 4, which is how because inflation reduces purchasing power over time, the real return on a financial asset is lower than its nominal return. First, for the effect of inflation on prices, inflation is a process in which general price levels of goods and services grow. That simply means that over time, the cash will yield progressively less amounts of goods as it buys as time marches on. For nominal versus real returns, nominal returns are those that have been named without adjusting for inflation. The real return adjusts for the inflationary pressure, thereby giving purchasing power realization in the real time. For example, suppose that a CD is offering a 5% nominal return, and if the return of inflation is 3%, then the approximate real return is 2%. So for current CD rates and how to calculate the real returns, currently depending on the term and institution, the CD rates range from 4.75% to 5.5%. With an inflation of about 3%, one would expect a return of around 1.75 to 2.5%. Topic 5 covers how the prices of financial assets change in response to market conditions, interest rates, company performance, new information, and investor demand. Here are several factors that influence the prices of financial assets. Increasing interest rates raise borrowing costs and therefore lower today's value of future money flows, ultimately depressing asset values. Decreasing interest rates almost always have a positive reaction on the pricing of such assets. The performance of firms. Financial results such as earnings, revenue growth, or product success directly impact the price of a company's stock. When performance is better than expectations, prices tend to increase. Investor demand. Prices rise when demand for an asset increases, whether driven by trend, speculation, or perceived value. Another factor that could potentially impact the price of a stock would be new information reported about companies or the products that they offer. For example, positive news would include the release of a new product or improved financial performance. For example, generally, if the stock price increases due to a forecast of higher future profits by investors. However, negative news, on the other hand, would be as the company's prospects deteriorate and the price will typically start to fall. Economic downturns typically result in high unemployment and can affect the prices of financial assets. For stocks, the prices would tend to fall due to decreased consumer spending, lower company profits, and an increase in uncertainty. For bonds, the prices of safe bonds, such as U.S. Treasuries, tend to increase when investors look for safer investments. The prices of corporate bonds would, however, decline with the increased risks of default. For real estate, prices are likely to fall since high unemployment diminishes purchasing power and demand for property. The market price for some assets, on the other hand, increases when interest rates decrease. Some examples are bonds and real estate. For bonds, this is because the prices of bonds tend to move inversely against interest rates. As rates plunge, existing bonds with higher yields become more attractive and surge in the market value. For real estate, a reduction in interest rates lowers the cost of borrowing for mortgages. This increases demand and hence the price for properties. Topic 6 covers asset allocation decisions. When making diversification and asset allocation decisions, investors consider their risk tolerance, goals, and investing time horizon. Here are some typical portfolio allocations between major asset classes for short-term and long-term goals. For your short-term goal, which would typically be less than 5 years, you would want to invest around 70 to 80% in lower risk liquid assets like cash, treasury bills, or short-term bonds. 20% to 30% you would put into the conservative investments like high-quality corporate bonds or dividend-paying stocks. You want to emphasize on capital preservation and liquidity as there's little time to recover from market volatility. For your longer-term goals, which would typically be more than 10 years, you would put around 60 to 80% in equities. For example, large cap, small cap, and international stocks, and 20 to 40% in bonds and alternative investments for diversification. So on the contrary, with longer-term horizons, one may withstand the market volatility and obtain higher growth potential of the stocks. Here are some pros and cons of investing in a diversified mutual fund versus investing in a small number of individual stocks. For diversified mutual funds, some advantages include diversification, since it spreads the risk as investments are made across many assets. For professional management, expert managers undertake research and rebalance the portfolio composition. Ease of access, which is ideal for novice investors with a small sum to invest. However, disadvantages include fees. There are many management fees that can erode returns given the time. There's also less control, as investors have limited control over specific securities selection. For individual stocks, some advantages include the control. Investors have choices about where to put their investments. There is also return potential, as high flyers return much higher returns. However, disadvantages include higher risk, as there is poor diversification and a chance that the loss may be incurred. Here are some suggestions for appropriate asset allocation for a risk-averse person versus a risk-tolerant person. For the risk-averse person, you would put around 70 to 8% in bonds. These can include treasuries, municipal, or high-grade corporate bonds. You would put 10 to 20% in dividend-paying stocks or defensive sectors like utilities, and around 10% in cash or money market funds. For very risk-tolerant people, you would put around 80 to 90% in equities. This would include growth stocks, small-cap stocks, and international markets. The rest, 10 to 20%, you would put in alternative investment, which include things like real estate, commodities, or high-yield bonds. Next, I'll be going over how target date retirement funds reallocate investments over time to meet their investment objective. So how do they work? The target date fund usually is designed to meet retirement needs of a certain year, say 2050. They automatically adjust their asset allocation over time and become more conservative as the target date approaches. So for the reallocation process, in early years, which is typically far from retirement, there would be higher scales of stocks to capture growth. However, as we get closer to the retirement, this gradually shifts to bonds, treasuries, securities, and cash equivalents as priorities begin to shift towards stability and income. And the overall objective of this is to match risk and return with the investor's changing needs, reducing the possibility of losses as retirement approaches. Topic 7 will cover the expenses of buying, selling, and holding financial assets and how they decrease the rate of return from investment. So how do the expenses associated with buying and selling investment impact rates of return and investment outcomes? For transaction costs, some of these costs can include brokerage, bid-ask spreads, and commissions that eat into returns or increase losses when there is selling and buying of assets. If one is a frequent trader, these costs could accumulate and seriously reduce overall returns. For management fees, ongoing expenses such as mutual funds or ETF expense ratios are an erosion factor of the growth of an investment over time. This is sometimes due to compounding effects. For example, a high expense ratio of around 1.5% annually will not add returns far quicker than one that is lower, say at 0.2%. There will also be tax consequences. Selling an asset may result in the realization of capital gains taxes, lowering after-tax returns. Actively managed funds tend to have higher turnover, thus increasing taxable events. For holding costs such as account maintenance fees or custodial fees accumulate over the life of an investment, typically, especially for smaller portfolios. Next, we'll be comparing the expense ratios for several mutual funds. For index funds, some examples include Vanguard, S&P 500. The ETF would be around 0.03%, and these funds track some sort of market index and are less expensive to operate due to low turnover and no active manager seeking to outperform the market. For actively managed mutual funds, for example, American Funds Growth Fund of America, you'd have around 0.61%, and actively managed funds need a research team and a high portfolio turnover, hence increasing their costs. For specialized funds, for example, small cap or international equity funds, these may be much higher at around 1% or even higher, and this reflects the added research and trading costs. Actively managed mutual funds usually have a higher expense ratio than an index fund. This can be due to higher trading activity. Due to periodic buying and selling, there are always transaction costs and taxes involved, which are further forwarded to the investors. There will also be marketing and distribution fees, and several actively managed funds charge like 12b-to-1 fees for promotional and distributional expenses. There might also be customization. An actively managed fund requires more resources and better equipment in an attempt to outperform the market. Next, Topic 8. Tax rules affect the rate of return on different investments and can vary by holding period, type of income, and type of account. Here we'll be comparing tax rates paid on interest income versus short-term and long-term capital gains. For interest income, let's say that the interest earned through savings accounts, CDs, or bonds represents your ordinary income, which in the U.S. has ordinary income tax rates between a minimum of 10% and a maximum of 37%, depending on your tax bracket. So your short-term capital gains are made from the sale of investments held for less than a year and are treated as also ordinary income and hence become liable for tax rates as high as 37%. However, your long-term capital gains are made from the sale of investments held for more than 1 year, and these are subject to more favorable tax rates. For low-income earners, it can be as low as 0%. However, for most taxpayers, it'll be around 15%, and for the wealthiest, around 20%. Here are some advantages of investing through a tax-deferred account such as an IRA or 401k versus a taxable account. So if you're there's tax-deferred growth. Investments will grow without reduction by taxes on interest, dividends, or capital gains until withdrawal, thus maximizing compound growth. There will also be immediate tax deduction, traditional IRA, and 401k. These accounts may or may not be tax deductible, reducing your taxable income in the contribution year. For tax-efficient withdrawals, the withdrawals are ordinary income, which is typically a good thing if you're in a lower tax bracket in your retirement. Here we'll be investigating the contribution limits and tax advantages of a traditional IRA versus a Roth IRA. For a traditional IRA, for contribution limits, based on 2024, it's around $66,500 annually, or $7,500 if 50 and above. for age. For tax benefits, the contribution may be tax deductible depending on the size of your income and whether or not you are participating in an employer-sponsored plan. Taxes are deferred beyond distributions, but all distributions are taxed as ordinary income. For Roth IRAs, the contribution limits, at least based on 2024, are the same as for traditional IRA, with limits to income eligibility. So this would be concerning $135,000 to $153,000 for single filers, or $218,000 to $228,000 for joint filers. For tax benefits, while the contributions are paid in after-tax dollars, the qualified withdrawals, along with accrued earnings, go completely tax-free, giving it the plus for long-term growth.